Good morning, everyone. Welcome to the Center for American Progress Action Fund. Thank you for coming out this morning. We will be getting started in just a couple of minutes. Two brief reminders before we begin. First, please silence all cell phones and other electronic devices. Second, there will be an audience question and answer between both sets of discussions. So please wait for the microphone to come to you. State your name and affiliation before your question. Thank you.
Good morning, everyone. My name is Neera Tandon, and I'm president of the Center for American Progress Action Fund, and I'm really thrilled to welcome you to this special event. We're gathered here today to help repair a fundamental flaw in our economy and our society as a whole. Right now, our tax code operates under two very different set of rules. One set for the super rich and another set for the rest of us. We have a system in place that taxes hard-earned wages of teachers, nurses, factory workers with every single paycheck, while allowing members of the top 1% to accrue untaxed income from assets such as stocks and real estate holdings. Thanks to this flaw, wealthy Americans receive preferential rates on the income that they derive from wealth. What's more, they have the luxury of deciding when to pay their taxes on these sources of income, and oftentimes they can avoid paying any tax at all. This unfair and unequal system costs our government hundreds of billions in tax revenue each year, revenue which could be used to create greater opportunities for families and communities in every corner of this country. That would mean more investments in schools, infrastructure, healthcare, the whole panoply of issues that actually improve the lives of many Americans. So it is long past time for Congress to take action. That's why today we're proud to host a leader who's put forth a series of bold solutions for finally getting our nation on the right track on this issue, Senator Ron Wyden. During his time as senator from Oregon, he stood as a strong voice for one progressive cause after another, from safeguarding the environment to rebuilding our infrastructure and expanding affordable health care for all. As the highest-ranking Democrat on the Senate Finance Committee, Senator Wyden is also responsible for ensuring that our economy works on behalf of every American, and he takes that very seriously. 2 years ago, he led the fight in Congress against President Trump's tax giveaway, which favored corporations and the wealthy, and which has failed to produce the benefits that its supporters promised. And today, he's released a new paper which outlines his plan for creating a fairer system that treats all Americans equally. We're so grateful for Senator Ron Wyden's leadership on this critical issue of progressive tax reform and on so many other issues as well, and it's my great honor to welcome him to the stage.
Neera, thank you very much, and I don't want to make this a full-fledged bouquet tossing contest, but the fact is CAP is there again and again and again for the priority issues that Americans and families care about the most. So I won't go through all of the wonderful causes that we've work together on, but Nira is sort of the bionic woman. If there's something important, she's there, and CAP is there, and we appreciate it. Now, I'm especially pleased to be able today to offer, hopefully, a few thousand especially well-chosen words about the fascinating subject of taxes. Now, I have always been a policy guy. So when I came in, I said, this sure looks like a convention of all of us who some Americans might say make up the nerdiest room this side of the Jet Propulsion Laboratory. And I think, obviously, some people think talking about taxes is some kind of medical grade sedative, but I think everybody here knows what the stakes are and why this is so important. And I want to start with something that I think is little known, but it touches on something CAP has really been a leader on, and that is, I think working class families now have come to understand a lot more about how exactly they are getting scammed by the powerful and the special interests. And the fact is, tax lingo, and people like Lily and David live this stuff night and day, is incredibly complicated, extraordinarily dense, and it is not that way by accident. The mega wealthy and the special interest lobbyists want it that way. They pay huge sums every year to what I call the armies of tax avoidance artists. This is the group of skilled lawyers and accountants who essentially toil mightily to open these loopholes and whittle their clients' bills, these multi-million-dollar investors, so they can get multi-million-dollar tax ripoffs. And the tax avoidance artists do more than just help their clients get these goodies. They go out and basically tell the middle class why these trickle-down promises really are actually very good for them. And it simply is to the advantage of the multimillionaires and the billionaires to have these complicated schemes we're going to talk about this morning cloaked in astoundingly complicated language. And that is why I am going to spend the next few minutes trying to put this stuff into something resembling English. And then we're going to have a terrific panel that I know is going to pick up on that and do it more eloquently than I have done. Nira made the central point that you have to start with. There are, in fact, two tax systems in America. And what I think is becoming increasingly better understood is that the first system, the system for the teacher or the cop, it is a mandatory system. You don't get out of anything. Once or twice a month, your taxes are extracted from your paycheck. No Cayman Island deals for you. No accountants trying to find a way to cut you a break. That is system number one. The second code, picking up again on Nira's initial kind of comments, is for the people at the top of America's economic pyramid. Those are the people who benefit from system number two. And we're going to talk about how they have been able, when workers are subject to mandatory tax payments, this second group gets to a great extent to choose when they are going to pay, and in a fair number of cases, whether they're going to pay any taxes at all. And what the Trump 2017 tax bill did is essentially widen the already unfair tax system in our country. In other words, it was unfair. We tried on a bipartisan basis to make it more fair. They went in the opposite direction. Now, a statistic buried in a little noticed Federal Reserve study, exactly the kind of document that all of us in this room consume on a regular basis. It shows just how problematic this is to our economy. The Fed study shows that half, just remember that, half of all of the wealth built up in U.S. mega fortunes goes untaxed. So picture how somebody who's driving their kids to a school with overcrowded classrooms, driving on a crummy road, worried about their retirement, feels when they hear half of these really big mega fortunes go untaxed. So this is where I think we've got the opportunity to kind of make a case that hasn't been made to America. And that is the wealth in these mega fortunes multiplies itself over and over again. And I think we ought to call it a tax avoidance feedback loop. And the mega fortunes get bigger and bigger, and they are propelled, they have this kind of jet propulsion behind them, by the favorable capital gains tax rules that go overwhelmingly to the top 1%. So this unfair tax system is a serious drain on America's ability to meet its most basic commitments, and none, in my view, is more important than upholding the guarantee of Social Security. My proposal, that I'm just going to outline for you now, provides a specific path for ensuring that millionaires and billionaires pay what they now owe, and that revenue is used to save Social Security. And I want to say that right at the beginning of this, because I've got a lot of people out on the campaign trail that I admire, I'm going to work closely with, and I just want to make it clear. It is one thing to talk about new taxes. That is one thing very much to be debated and will be debated on the campaign trail. What I want to do is I want us to be able to stand up in front of working class people and say, job number one is to collect the taxes that are owed. And that is the proposal that I'm going to outline now. Our proposal comes down to two key changes: equalizing the tax rates for capital and wage income, and ending what I think is an extraordinary scandal, little known, and that is the benefit of being able to defer paying your taxes, particularly your capital gains taxes. And this deferral process is such that you can defer, and you can defer, and you can defer some more, all the while the cop and the nurse are paying every year. And then if you decide to just keep deferring, maybe after you pass, you hand your winnings over to Johnny and Mary, and they just keep doing the same thing. So you can have generation after generation doing this. So you start with wages and wealth being taxed at the same rates, because we ought to close the book on the trickle-down fantasy era. Today, 70% of capital gains goes to the top 1%. In other words, up on that economic pyramid that I described, where the air is pretty hard to breathe, the top 1% gets 70% of the capital gains. So it's clear that giving them a break is a break for a very small number of people. And there isn't much evidence that it's productive economic policy. The failure of the Trump tax handouts to corporations and the ultra-rich, in my view, ought to end the trickle-down discussion. So it is time to treat wages and wealth the same way under federal tax law. That said, that alone is not all that we ought to be focusing on as we try to make sure that people pay what they actually owe. A real fix requires addressing what I consider the least known big tax ripoff, and that is tax deferral. The tax deferral is the primary way that the ultra-rich get their money's worth from tax avoidance artists. It allows them to delay tax bills indefinitely, potentially until they can pretty much vanish. It's not fair to anybody else, and it has to be a priority for tax reformers in 2021. We're going to debate a lot of things between now and 2021. But I know, and I was just home for town hall meetings, and I tell people, you know, how many of you pay taxes every month? Everybody raises their hand. How many of you know that people at the top with all these lawyers and accountants can pretty much pay what they want, when they want, and just defer it and defer it and defer it? And people just kind of, you know, look slack-jawed at you because they knew that there was a lot of unfairness, but they didn't know about something quite that stark. So what my proposal does, the centerpiece, is to create a new anti-deferral accounting system. And I realize, boy, now everybody would say, Ron's really off into wonkland. You know, we're going to talk about, you know, accounting rules. And so what I'm going to try to do is describe why the stakes are so high and to try to make this real. First of all, it would apply to a fraction of a fraction. I can tell you the tax avoidance artists, they're going to be out there saying that this is going to be pretty much the end of Western civilization, and if you're a middle-class person, you better hang on to your home and your retirement account and your family farm and all that. My proposal does not apply to that and to the middle class in any way. Not in any way. Should I repeat it again? I think I've made my point. Doesn't apply to the middle class. It applies to the top 3/10 of the top 1% of earners. Nobody else. The new system requires the mega wealthy to pay tax each year on gains from easily traded assets like stocks and bonds. In down years, they could take losses. For assets like real estate or privately held businesses, assets that are not as easily traded, my proposal would minimize the benefit of deferral by assessing a look-back charge when the asset is sold or transferred. So the system, as I say, applies to only those at the top, defined as those who have at least $1 million in income or $10 million in assets for 3 consecutive years. In the near term, the proposal would include transition rules to move away from this broken mess that we've got now to the kinds of reforms I'm talking about and make sure that it's done in a responsible way with a transition. Our preliminary committee estimates indicate that this proposal could raise between $1.5 and $2 trillion over 10 years. That is enough to shore up Social Security almost into the 22nd century. All right? We know that we have this freight train barreling at working class families in 2034. The proposal that I have just given you in capsulized summary means that somebody tonight in their 50s can go to bed saying that what these folks are doing is making sure that those at the top pay what they owe, and that money is being used so I no longer have to fear that the Social Security guarantee will not be met. So we're going to take this out across the country. I've been talking to my colleagues in the Congress, on the Finance Committee, off the Finance Committee. I can tell you, on the Finance Committee, for example, my colleagues have been floored at the recent figure that was in the Wall Street Journal saying that there's something like $3.8 trillion in untaxed assets, just liquid untaxed assets. And then you got real estate on top of it. So we got a lot of educating to do, but we've also got a lot to work with, because people say, what happens to that money, Ron? I said, well, it just kind of sits there. And I'll talk a little bit more about that. So we're going to hear lots of arguments against this. They began even before we released it. But let me kind of start with the kind of basic, kind of proposition, because I don't think these arguments pass the smell test. For example, we're going to hear on one hand, millionaires and billionaires are going to argue they can't come up with the cash to pay what they owe. They're going to make that argument, while on the other hand, they're going to argue that having to pay the tax chokes off their ability to have all these job-creating activities going on, their generous investing, and keeping their trickle-down system going. You can't have it both ways. You can't say you don't have the money to pay and then say, well, make sure you protect my money so that I can continue business as usual. Then we're going to say that mark-to-market, these folks will say, unprecedented. Oh my God, think of what these people have thought up. Never been done. Oh my goodness. The fact is, it's been around in various forms for decades. It's applied to Section 475, if you want to talk about it. We can talk about that one. But it's applied to futures, it's applied to stocks, it's applied to a variety of areas. It's been on the books for years and years, and no accountant would leave home without knowing about these breaks, and no billionaire investor would employ an architect who was unaware of the mark-to-market requirements that are on the books today. Then we will, I think, see the centerpiece of this being the tax avoidance cavalcade. Will say that this is going to harm, the middle class, and I've already taken you through, those kinds of numbers. But here we're going to make sure that everybody understands that the proposals includes big exemptions for homes, for retirement accounts, for family farms. So this idea that the middle class is going to get hurt is just a fiction. Now, I also want to kind of make sure you understand that in addition to the fact that this is just basic kind of fairness, the notion of saying that you ought to pay your fair share and you can't just sit on these unrealized, gains without any consequences, I don't see the argument that this is somehow going to be the end of Western civilization or a danger to the American economy. I think it's a fantasy, and I'm going to tell you why now. Trillions of dollars of potential investment are now sitting static in the American economy. They're being held captive because you can do really well, as I've outlined, under these tax referral ideas. I believe that the proposal that I'm outlining to you will help liberate those dollars for productive uses. It will unlock those funds for communities across the country. And if there's no longer a hugely disproportionate tax break to keeping those dollars parked, what will happen is they will circulate into new, more productive investments. And that offers the potential of a major economic boost. And I also want to offer up a couple of other facts about unrealized gains. Multimillionaires and billionaires are not sitting around living monastic lifestyles because their gains are unrealized. There are plenty of ways they can unlock their fortunes without selling. I mean, they can borrow against all of those assets and continue to have an incredibly enjoyable lifestyle. They can borrow against those assets to take out loans from big financial institutions. That way they're paying a few points of interest to a bank instead of paying their fair share in taxes. Just wrap your arms around that, and I think you'll see something else that will connect with workers. And the tax avoiders and their multi-million-dollar and billionaire clients are also going to get to write all this off. And without going too much further, based on the little amount we know about Donald Trump's taxes, it sure sounds like what I've just described is something that has been used fairly extensively by the Trump household. So this is an unfair economic privilege that isn't available to working folks, cops and nurses, folks in the trades. They can't defer their tax bills until they vanish. They can't, in effect, blow off the IRS for years and use the money to pay the rent or medical bill and use the money to pay the rent or medical bills or college tuition. They cannot blow off the IRS and use the money for what they choose. See, what you're talking about are the gains that go to millionaires and billionaires of the wages earned by workers. And it seems to me when you're talking about the gains of workers and the gains of millionaires and billionaires, the tax rules ought to operate on the same principle. So here's what we propose doing as part of the next step of our reform package. And that is, we believe having these millionaires and billionaires pay their fair share really ought to be used to shore up Social Security. It's the number one priority of working people. There isn't a middle class in America without it. Social Security can pay full benefits until 2035, but after that the system can pay 80% of benefits, meaning you're talking about a 20% cut unless there is action. That cut cannot happen, and I just want to say, as long as I am the ranking Democrat on the Senate Finance Committee, it is not going to happen on my watch, period, full stop. Social Security is too important. And as I indicated, if you're 50 years old, today, and you've read these, headlines that we're going to have benefit, cuts in 2035, this isn't some kind of abstract issue. I compare it to, that family saying a freight train is coming barreling right at them. People want to know that they're going to get the full Social Security benefit they were promised. So Congress needs to get serious about addressing this oncoming crisis now. And the anti-deferral tax proposal I've outlined is what I think is the best way to go about doing it. The goal is to create a tax system that finally treats ultra-rich tax avoidance folks, their lawyers, accountants, the people who benefit with them, from the same principle that applies to everybody else. You pay your fair share every year, and it has the benefit of protecting the Social Security guarantee as well. I've been talking for some time since I got on the Senate Finance Committee about this tale of two tax codes in America. I can't think of a better time to create a tax system that works for everybody, one system, than right now. People have seen what the consequences of this are. They have seen some of the most powerful people, in the country misrepresent and out lie about taxes. I was in the White House and Donald Trump said point blank, people like him shouldn't get a tax cut. He had a whole big group of Senate finance members. Well, last time I looked, the top rate for folks like Donald Trump actually went down. So the issues that we're talking about here today, I think, give us an opportunity to break some fresh ground. As I've indicated, it's one thing to talk about new taxes, and we're going to have a big debate on the campaign trail about it. But let's make priority business collecting what's owed from multimillionaires and the billionaires. Let's say that's job number kind of one. So thank you all for having me. So many good things in terms of trying to help families and seniors and the vulnerable have started in this room, have started in CAP, and I thank you for the chance to come, Neera, and to all the CAPers, and just look forward to working with all of you in the days ahead. Thank you. Over there? Good.
Thank you so much, Senator Wyden.
All right.
Just sit right over there. We have time for a few questions. I'll ask one or two, and then we'll take questions from the audience before the next panel. So you talked briefly about, you referenced a town hall you'd recently had, and I would love to hear from you how, when you talk about taxes and the tax code with your constituents, what do you hear most from them, and what do you hear most from them about the unfairness in the system?
I think, Neera, folks, working families can smell the cheating at the top. I mean, it has gotten so out of hand that I think they've really caught on to the scam. And I think there are a lot of ways you can describe it, but I think they do understand that there's a double standard here.
Mm-hmm.
There's one set of rules for them that's mandatory, there's another set for everybody else. And I think it would be fair to say, if I walked into a coffee shop this afternoon in Coos Bay, Oregon, a town on the South Coast that I love, I think it'd be fair to say not everybody is up on tax deferral and the various things we're talking about. But I think they know that there are a lot of games and scams that are used by what I call the tax avoidance, artists, and it reflects their judgment that the system is broken. And so my constituents, and I think Americans, want a system that's fair. They want a system that gives everybody in America the chance to get ahead. And that's what we're talking about.
Great. You referenced the Trump tax cut towards the end of your remarks. I think it would be helpful for people to really just have a side-by-side of the steps the Trump tax cut took, and how its impact and what it did for people at the lower end versus what it did on the higher end, and what it did particularly on the issue of capital gains, which is really the differential in treating work versus wealth. It's one of the central elements. So essentially, I just asked, 2 years later, we've now lived with the Trump tax cut. What's your assessment of the direction it's gone, and how is your plan in contrast to that?
Well, Neera, first, I think the number of fantasies associated with their arguments keeps piling up. I'll give you an example. Right now, in the Senate, there is a bipartisan effort to fund a roads and bridges and infrastructure, program. And I mentioned it in my comments. Everybody knows our infrastructure is falling apart. And there are traffic jams in America, in my state and elsewhere, where nobody could even dream there would be a traffic jam 5, 8, 10 years ago. Well, the fact that the Trump crowd borrowed $1.5 trillion to give these breaks to the people at the top not only was unfair, but it's one of the biggest challenges to getting the money for the roads and bridges and infrastructure. And I'll just say I personally think it was political malpractice for the Trump people to decide to go first with their ideological agenda, gutting the Affordable Care Act and this tax bill for folks at the top, when the whole Congress was ready to go in a bipartisan way to work on, infrastructure. Right. So I think their priorities were distorted right at the top, and a lot of it is, as I say, just been fiction. Middle-class folks. The average household was promised a $4,000 rise as a result of trickle-down economics. I think a lot of people have said, with respect to trickle-down economics, they have had it with being trickled down on. I think they get it, and I think they get what it means for them.
Great. I'm going to ask one more question, then we're going to go to the audience. So folks prepare for actual questions. Finally, should we think of your proposal as a standalone issue or something that would be part of a broader reform of the tax code?
My sense is, and there was discussion already this morning in some of the press about tax reform in the future. I think clearly Democrats see that the 2017 bill needs a comprehensive overhaul. We wanted something that was built around growing the middle class and creating the kinds of job opportunities that allow for high skill, high wage positions. So I've been on a variety of approaches. I've been on Sherrod Brown's bill. I think the earned income tax credit empowers folks of modest means to climb the ladder of economic mobility. Obviously, the corporate tax, where it is still more attractive, folks, to do business overseas than it is to do it in the United States, would be right up at the top of my list. So I think we're going to see taxes writ large as the debate in the Senate Finance Committee in 2021, and that's as it should be. So much of what was promised in 2017 hasn't panned out. In fact, it got to the point where this time at home, somebody who thinks it's just a disastrous bill said, well, I tried to think of one good thing about it. And I said, oh? And he said, your bill on craft beverages to help the small beer, wine, and cider, we can keep that standing. We'll keep that. And the rest of it's pretty gross.
Excellent. Well, with that, I'm going to go to the audience. I really want to ensure that we have questions. And if you can identify yourself and where you work, that would be great.
I'm Carl Pulzer. I started a project 4 years ago called the Center on Capital and Social Equity after reading about inequality to explore the dynamics. And I also advocate for the bottom half, the baskets of deplorables and the rest from both parties. So I agree with you that we need to tax the wealthy. My analysis goes there. All the Democrats focus on the 1%. But and I agree maybe that's enough for Social Security, although there are other ways to fix that, like raising the cap on the payroll tax. But the task to help the bottom half, there's such a heavy lift with getting everybody health insurance, getting everybody $500 of a tax credit into a retirement account, all kinds of things. I think Democrats would be more credible, and here's the question. If they talked about the top 20%, and that includes Democratic constituencies like doctors, lawyers, people making over $100,000, but to just talk about the 1%, If we're gonna have to pay more. It makes you sound more credible, not just they. Okay, that's just my question. Does that make sense?
Yeah, no, listen, this is an issue that we're going to have a vigorous debate on, and I'm going to take a minute or two with this, if I could,
Yeah,
Nira,
please.
because thanks for having a size 7 halo on your head, because you're clearly, you're really going to bat for, folks who don't have clout and don't have lobbyists, and God bless you. I think part of this, and this is why I said it several times, because I think it reflects kind of my philosophy. Your point about credibility on taxes is particularly important because Nira and CAP have done lots of polling on this. Over the years, sometimes Democrats haven't done too well in terms of the polling. So that's why I've wanted to frame this as let's focus on getting these multimillionaires and billionaires to pay what they owe now. They owe this now. And then as we unlock these assets, and part of what has driven me, and your question is a very good one. We could spend hours on it and kind of talking through, all of the ramifications, the implications unlocking $3.8 trillion. And remember, this was not some left-wing, publication. The Wall Street Journal had it, in the friggin' front of the paper. That is an enormous sum of money to do the very kinds of things that I think you and I and people who share our values want to see done. So if you want to get some credibility, and I deal with this in the Finance Committee all the time. For example, Senator Grassley and I put together, defied the odds, a major prescription drug reform bill. Nobody thought we could do it. Basically, it has specific language backed by a Republican to stop price gouging. The companies don't have to go along with everything, but if they price gouge, they are going to lose their subsidies. And I thought that was a good credibility builder. And our senior advocates and others went out to the grassroots. Now, other people have different views, but I think it's fair to say that while our proposal is a start, Speaker Pelosi took our two big things out of a bipartisan bill. One was our out-of-pocket cap for seniors under Medicare who don't have it, and second was penalties for big pharma when they gouge seniors. She seems to have a little different version, but all the progressive folks said she picked up on an idea that we got Republican support for. So I'm thinking about exactly what you're talking about all the time. And a big part of my thinking is if we want to have credibility, let's start by saying these multimillionaires and billionaires who really are a fraction of 1%, they ought to pay their fair share. Let's come right out of the box and say that.
We'll go to another question over here, but I just to follow up very briefly on this point, I do think on the issue of credibility, sometimes the credibility discourse is really just thinking about earned income from wages, and I think the point that you're making is that too often we're not thinking about all of wealth, and because our tax code, as you said, is really, one is designed for income derived from work and another is from wealth. And so I think what's been really fascinating about the debate over the last year or so, and particularly crystallized in your report, is how many problems you could solve if you taxed wealth in a different way than we've taxed it before. So I just want to plug that it's not a small step you're talking about. This is a big, important, big, bold step that would fund not just Social Security, but many other things as well. So we have one question over here, and if you could just identify yourself.
Thank you very much, Senator. I'm a
Get Nira to run for one of the open Senate seats.
I'm a federal retiree whose taxes went up thanks to the Trump 2017 tax bill. Thinking to that process in which it could be argued that those wealthy accountants and millionaires were in the back room actually writing that bill up until the last minute, and at least one senator, then Senator from Kentucky, it was reported that a change was made and he benefited by some $20+ million, and he ended up voting for that bill. So this is my question. So imagining a world in which the Democrats have a majority in the Senate and the House and in the White House, how do you foresee a process to get these bills and tax changes in a transparent, public, with hearings? How do you envision, or do you envision that as a public process?
You're being way too logical, and heaven forbid that logic, break out. Last week, I had my 950th open to everyone in Oregon town hall meeting. This was a pledge that I made to my state because I think, particularly in a Citizens United world, and like a lot of Democrats, I want to throw Citizens United. This is a Supreme Court decision that basically says that the rich person's checkbook is exactly the same thing as the poor person shouting to everybody on the sidewalk downstairs, which is, an absurd, judgment. So there are going to be a lot of areas we're going to want to reform. But I will just tell you, I, as the ranking Democrat, and my colleagues on the Finance Committee are going to make it clear. We're going to do the hearings. We're going to have openness. We're going to have transparency. We're going to have accountability. And this kind of has been my hallmark of my public service. I value this more than anything else because this is a time when people have, understandable frustrations and anger about government. And one of the biggest reasons is they don't even get a chance to be heard. They don't get a chance to be heard. And I know that, a lot of those special interest, lobbyists are taking people to various resorts and stuff, playing golf. I just finished a big round of town meetings because I share your view.
Excellent. We have time for one last question over here. Just again, identify yourself, please.
John Cummings. Wealth taxes have been tried in a lot of countries, and they've failed in most of those countries. They've overpromised what income they would deliver and under-delivered on that and basically been withdrawn. I think what you're proposing is a great 19th century idea, but in a global economy where money is much more fungible, you're really setting, I think, a system that isn't really going to work. Also, you seem to be pointing to...
Can you ask us a question?
Yeah, so the question is, it sounds like you don't simply want to tax real income, but you want to tax unrealized income. It's not
And the question.
deferred. Well, is that true? So you wish to tax, so someone in 2007 who had X amount, $10 million and $11 in the market that crashed 50%, that money disappeared. They never saw it. Never was real income to them.
Well, a couple of points. I don't take a backseat to anybody about thinking about economics with a global kind of perspective. I come from a part of the world where 1 out of 5 jobs revolves around international trade. The trade jobs often pay better than do the non-trade jobs. So everything about my views on economics is not about just selling blueberries from point A to point B. It's about global economics. That gigantic hoard of money, much of it is generated not just by local kind of sales, it's generated in global markets. And what we have always traditionally said is when you're an American and you generate money, you pay your fair share, which is what I'm talking about. And when you talk about unrealized gain, I want people to understand that the way the tax laws work, and this is a good one to quit on. I went to school on a basketball scholarship, and I always said you're supposed to stay until you can make one shot that you agree with, that was one you thought. That unrealized gain allows them to continue to make more and more money tax-free. They can take that money not just for their lifestyle, they can take money from the asset pile to invest in it because they own all the assets and nobody's taxing them. Somebody can come in and say, hey, let me give you more. So make no mistake about it. Because you have tax deferral, you have a constant income generating feedback loop day in and day out. And if you really want to think about it in a way that it's only 11 o'clock, this will spoil your lunch. If you really want to think about it in its most insidious form, you can pretty much get out of paying taxes indefinitely and hand it off to the next generation, and they can go back to the same thing. So I appreciate your willingness to dig into the details. And for those of you that are gluttons for punishment, we really welcome your doing exactly what the gentleman is talking about. We have in the white paper, as we call what we're doing today, an opportunity for you to give your thoughts and your details. Tiffany Smith, I think, is floating around somewhere from our, did I see a hand? She's our tax counsel. I tell everybody, don't call her nights and weekends, but make sure you get us your input. And the reason I put all this time into doing this is we've got a year and 2 months, essentially, to get this right. Okay? Your ideas are welcome. Your suggestions are welcome. That's true for everybody else here. And you're going to have some terrific panel members talk to you in greater detail about some of these questions.
So I want to say a deep thank you to Senator Wyden for this really important contribution to the tax debate, and that we look forward to working with you, and also, most importantly, how this contribution is part and parcel of all the work you've done on a range of issues, from healthcare to prescription drugs to the environment, where you're really putting the needs of working families at the center of your focus. So thank you so much. And I invite our next panel up. Seth? Okay.
It has nothing to do with taxes, but I want to thank you for all.
Reform at finance.senate. I'm a senior fellow here at the at American Progress. Really excited that we had the chance to host this event with Senator Wyden, and we have a really terrific panel to discuss what we just heard from him. All of them are tax and economic policy experts, and also very good friends and colleagues of American Progress. So I'll introduce them in order. So Indivar Dutta-Gupta is Executive Director at the Georgetown Center on Poverty and Inequality, where he leads work to develop and advance ideas for reducing domestic poverty and economic inequality, with particular attention to gender and racial inequality. He also serves on the National Academy of Social Insurance's Board of Directors and a member of the Institute for Research Poverty, Employment, and Self-Sufficiency Network. Next, Lily Batchelder is the Robert C. Koppel Family Professor of Law at NYU School of Law, and affiliated with the NYU Wagner School of Public Service as well. She served as Deputy Director of the White House National Economic Council and Deputy Assistant to President Obama. And prior to that, Majority Chief Tax Counsel for the Senate Finance Committee. Her scholarship and teaching focus on personal income taxes, business taxes, wealth transfer taxes, retirement savings, and social insurance. Next is her colleague at NYU, David Kamen, professor of law at NYU School of Law. His scholarship focuses on tax and budget policy. And prior to joining NYU Law, he worked also in President Obama's administration as special assistant to the President for Economic Policy at the National Economic Council, and also as an advisor to the Director of the Office of Management and Budget. And I should say Lily and David are co-authors of a new paper for the Aspen Institute's Economic Strategy Group. It's called Taxing the Rich, Issues and Options. I would definitely highly recommend it. You can find it on SSRN. And finally, Greg Leisterson is the Director of Tax Policy and Chief Economist at the Washington Center for Equitable Growth. His research focuses on the economics of tax, social insurance, and retirement policies. And prior to joining Equitable Growth, he served as a senior economist at the White House Council of Economic Advisors and as an economist in the U.S. Treasury's Office of Tax Analysis. And he, too, he's written a new paper. It's a great explainer, actually, on mark-to-market taxation that really explains the issue very clearly. And you can find that at equitablegrowth.org. Okay. So let's get started. So I thought I'd invite our panelists to just give a few general thoughts and reactions on what they heard from Senator Wyden. And in particular, this is, I think Senator Wyden said we were deep into wonkland, but I was hoping Indy could start by putting this proposal in the broader economic context that we're in.
Thank you, Seth. So I'm just going to make 4 key points here. One is that income and wealth inequality are at staggering levels, including across racial and gender lines. 2, these inequities harm individuals, families, and our overall economy. 3, that this extreme inequality likely also harms our democracy. And then 4, a mark-to-market, anti-deferral, or similar tax is part of the solution. So, the first point, income and wealth inequality are at staggering levels, including across racial and gender lines. So just to take 1 year that was a particularly bad year for inequality, in 2015, the top 1% of households gained over 26 times as much income as the bottom 90%. Average CEO to worker pay ratios increased from 20 to 1 in 1965 to 278 to 1 today. And then across racial lines, a typical white family had 8 times more wealth than a typical Hispanic family and 10 times more wealth than a typical black family in 2016. And when you bring race and gender together, you see the racial disparities are even worse. So the median net worth of a single Latina woman is about $100, a single black woman about $200, and for a single white man, almost $29,000. All right, so the second point. These inequities really do harm individuals, families, and our overall economy. Just 2 quick arguments here. One is there's evidence from some OECD research that the extreme inequality results that we and other rich countries face result in lower post-secondary educational attainment, limited job opportunities, and depressed lifetime earnings for people at the lower end of the income distribution, especially thinking about the gap between the lower end and the top. This isn't just about poverty. This is actually about the inequality. And then secondly, our economy as a whole arguably is stifled by this wealth inequality. Some folks might have seen a recent McKinsey report that suggested that the racial wealth gap can cost the U.S. up to $1.5 trillion or 6% of GDP by 2028 due to the opportunity cost of lost investment and consumption, specifically by African American or black households. A third point, this extreme inequality likely also harms our democracy. So there is some evidence that political participation is pretty unequally distributed in the U.S., voting, of course, but even beyond that, and strongly linked to socioeconomic status, and that our national politics in particular disproportionately values the interests and opinions of the wealthy and businesses over the working and middle class. Maybe that wouldn't matter if they had the same interests as the rest of us, but I can assure you they don't. So the final point, a mark-to-market or anti-deferral or similar tax is part of the solution. So the first thing to keep in mind is that a mark-to-market tax that actually corrects some market failures. Our friend Michael Linden has made this point, a former capper. Ensuring the wealthy pay their fair share can address some of the market inefficiencies we see, like unjustified and outside CEO pay, and help ensure that there's a greater chance that wealth and income are actually the result of real growth and productivity rather than luck. The second point, a more progressive tax system can generate crucial revenues we need for some of the critical investments in physical infrastructure, education, scientific research. And in particular, one of the points that you'll see in David and Lily's paper, ensuring that especially people in the lower end of the economic distribution have a chance, real chance to move up by having the basic foundations that they need, including healthcare, early childhood education, even food, housing, to really contribute fully to the overall economy. One more point here, that a mark-to-market tax can actually also help address racial and gender inequities. So the current federal tax code is certainly progressive overall. There are certain features, however, that can exacerbate racial and gender equity. And we're working on some of these issues with the National Women's Law Center, so there'll be a few forthcoming papers from them that will help explain this to folks. But in general, the tax code at times rewards wealth accumulation and inheritance, and particularly for people with the most resources, which can disadvantage families with low incomes where people of color and women are overrepresented. And the final thing I'll say is, in a time of virtually unprecedented economic inequality, heightened along these racial and gender lines, our collective response should include and must include a more progressive federal tax code. So structural reforms like a proposal that Senator Wyden has laid out can help ensure that the wealthy pay their fair share, raise much needed revenue, make the tax code more efficient, and advance the economic, social, and political imperative for addressing income, wealth, racial, and gender inequities. So I hope other policymakers will pay attention to this path-breaking proposal.
Awesome. Thanks so much, Indy. And Lily, I was hoping you can address sort of what's the, describe in greater detail sort of what's the problem with the tax code? Like, why is the tax code so fundamentally broken that is so in urgently need of reform?
So first I wanted to thank Seth and Nira and Cap for having me here today, and Senator Wyden for a bold proposal that I think is really going to advance the discussion on these issues. There's a lot of problems with our current system for taxing the wealthy. The key thing to understand is that the very wealthy earn and report their income in very different ways from most of us. So if you look at the bottom 95% of taxpayers by income, they get about 80% of their income from wages and salaries. But if you look at the tippy top, the top 1 in 100,000 taxpayers, they only have about 10% of their income reported as wages and salary, and about 84% from capital gains, dividends, and private businesses that they own. And this basically gives them opportunities to lower their tax rates in ways that aren't available to most of us. So one of the big things that they do is report what is probably labor income as business income. There is a recent paper that I commend to you by Matthew Smith and others that finds that 3/4 of pass-through business income actually represents labor income of the owners. They're able to do that. They are also able to take advantage of what we sometimes refer to as the Edwards-Gingrich loophole and loopholes in the net investment income tax. And then there is the new pass-through deduction, all of which can take their top marginal tax rate down from what it should be at 40.8%. We have a top ordinary rate of 37%, and then the net investment income tax is 3%. But they can get it down through these techniques to 29.6%. And then they can go further and characterize a lot of this income as capital gains and dividends income. And if they take advantage of those Edwards-Gingrich loopholes again, they can get their top rate down to 20%. And then the final technique, which is really the focus of Senator Wyden's proposal, is that they can take advantage of tax deferral. And as he noted, that doesn't necessarily mean you don't spend your money. You can often borrow a great deal of money from your assets or based on your assets if you're very wealthy. But by being able to defer realizing capital gains, they can take their tax rate potentially all the way down to 0. If they defer long enough, that would be the tax rate in close to present value terms, or because of a provision called stepped-up basis, ultimately all of their gains may be tax-free. So to give you a sense of scale, about 40% of the wealth of the top 1% is in accrued and unrealized gains. So that doesn't even show up in tables about how much income the very wealthy have. And two recent papers have estimated that the wealthiest realize less than half of their accrued capital income and therefore reported on tax returns in the current year. So all of this means there's a really complex patchwork of rates that is available to the wealthy and not available to the rest of Americans that ranges from anywhere from 0% to 40.8%. And I think this is one of the main goals of this proposal is to try to reduce that patchwork and make the wealthy pay at least at the ordinary rates that we would expect them to pay based on the tax brackets. So one obvious way to do this would be to raise the capital gains and dividends rates so that they're the same as ordinary income. And the issue with that is that if one did that on its own in isolation, it's possible that you would actually lose revenue. And the reason why is because of the great tax benefit of tax deferral. So the wealthy, if you started taxing capital gains at, say, 40%, might defer realizing those gains for so long that the fisc would actually end up with less revenue than if, say, the rate was 30%, which is what, roughly speaking, JCT and the Treasury Department estimate as the revenue maximizing capital gains rate. So one way to deal with this would be to repeal the provision referred to as stepped-up basis that forgives all tax on capital gains that have accrued at the point of bequest. It's unclear how much that would raise the revenue maximizing capital gains rate. There's one estimate by the Tax Policy Center that it might raise it to 50%. But that still would not fully get at the problem. And so if one really wants to equalize the capital gains and ordinary rates, the best solution is to start looking at provisions that reduce or eliminate the tax benefits of deferral. And I think this is why Senator Wyden is looking at this proposal and advancing it, and I'll turn it over to others to get into the details.
Nice. So David, how would Senator Wyden, his proposal, address the flaws that Lily just laid out?
So first, thanks for having me and for this great event and for being able to talk about what is a bold proposal by Senator Wyden. So a few points as to how a proposal like this helps address some of these key problems in the tax code. First, it makes sure that income doesn't disappear. And right now, a significant share of the income of the very top does disappear. It simply never gets reported on the 1040. Senator Wyden and Lily have referred to the statistics about the share of wealth that is simply accrued, so like actual income that has gone untaxed. There was another recent study looking at estate tax returns and then comparing those returns to the income tax filings made in the years up to that estate filing a return. And it found that the very, very wealthiest in the country seemed to be reporting a rate of return on their assets that was less than half of the market rate of return. And in fact, most evidence suggests when you look at the actual amounts they're making, they tend to make better, not shockingly, the very, very top, tend to make better than the average rate of return. So most of their income simply wasn't showing up. Now, when it comes to market, it makes sure that the major ways in which they make that income not show up on the return will show up on the return. So if you have a publicly traded asset, it will show up in the year the income gets made. If you have an illiquid asset, it shows up in the year that you sell it, and with a charge to make sure that you pay for the deferral of the tax. And importantly, it would also close the loophole, and it's a huge loophole right now, that combines deferral, allowing you to defer your gain, with entirely wiping it out, as Lily was referring to, at death, which is why we simply don't get a lot of that income in the system right now. Now, importantly, that combination, making sure that people with publicly traded assets pay up front, making sure those without pay eventually and are charged for the deferral, means that you're going to get a significant reduction in tax planning. And right now, as Lily was referring to the degree we increase rates on capital gains, you end up getting more planning that results, meaning that people can avoid higher rates. If we simply tried to increase the cap gains rate to the ordinary rate, you'd get more of it. It reminds me of a tax lawyer I was talking to the other day who deals with real estate folks tend to be at the top of the income spectrum in New York. And he was noting that, of course, and people know this, the game at the top, you never sell. You never sell a piece of real estate. You roll. To the degree it changes hands, you roll it over. There are ways to roll over the gain, so you simply don't pay on it. And that kind of planning, which could become even worse if we raise rates without changing the base, that kind of planning would go away. Another kind of planning that Lily was referring to that this would help address, since we can now strengthen that base, is the significant planning that occurs where you can shift your income between different rates, and especially the top rate and the lower capital gains rate. Right now, we are unable to really effectively bring those rates closer together or significantly closer together, simply because the capital gains base is sufficiently porous that if we simply increase the rate without changing the base, as Senator Wyden is proposing to do, we have the potential of simply leading to even greater gains of the kind that I was just describing when the real estate folks simply don't sell. But with this base now much stronger, it means that we can raise the rate, and then other gains that we have in the system, a classic that people sort of have in their heads is carried interest, where the private equity and hedge fund managers shift over into a lower capital gains rate, though it's really just their labor. Those go away. And the proposal by Senator Wyden, which would bring the rate up to equalize, would address that. Final thing I wanted to say is, to my eye, and I know this goes to a question that was asked before, this is very much a 21st century proposal. In fact, I think we do have to worry about what happens with capital going across international boundaries. One of the lessons of that is if we focus on more effective taxation of the individual, don't focus on where the income is, focus on who the individual is. Because turns out most people want to still be United States citizens. And you can impose an easy exit tax if they try to give up their citizenship. It is harder, though we should definitely do more about it, when dealing with corporations. And I think that when it comes to Senator Wyden's proposal, it focuses a tax on the very top end that makes it much harder to escape, and you actually can't escape it by simply trying to report profits in Ireland or whatever other low tax country you want. And so I think it also helps address some of those games as well.
Thanks so much, David. And then, so Greg, do you want to address some of the potential economic effects and the revenue effects, and how should we think about those in the context of this proposal?
Thank you, Seth, and thank you to CAP. It's a pleasure to be here today. I'll quickly touch on three different issues. First, the revenue potential of the tax. Second, the economics of tax avoidance. And finally, some of the ways in which this proposal builds on existing structures and principles that are already reflected in the tax code. So first, on revenues, right, the revenue potential of something like this is quite large, and that's for two reasons, which basically combine 2 points that Indy and Lily made. First, living in a period of high inequality, there's simply a lot of income in the upper tail of the distribution, and as Lily noted, that the folks at the top of the distribution are earning their income in very different ways than the rest of American families. And what this means is that capital gains and dividends account for about 25% of the realized income of the top 1%. That's about $600 billion on an annual basis. And that means that if you just take the tax expenditures for the preferential rates for step up in basis, take that, look only at the portion for the top 1%, that's about $1.5 trillion over the next decade. So we're effectively spending very large sums of money offering tax benefits to this advantaged group. Now, so that's sort of a looking at where we are now. What could we get from a proposal like this? As Seth mentioned, Lily and David just put out a paper that I encourage you all to take a look at. It includes revenue estimates for some stylized proposals along the lines of Senator Wyden's anti-deferral accounting or other mark-to-market type proposals. Based on survey data on household wealth, they estimate that mark-to-market for publicly traded assets, deferral charge for non-traded assets, that's this sort of style of proposal we're talking about here, would raise about $2.1 trillion from the top, if applied to the top 1%, from what I'll consider their benchmark specification, about $750 billion if applied to the top 0.1%, right? There's a bunch of dials you could choose on sort of how broadly you apply the tax in terms of people, in terms of assets, what rates you apply, but we're talking about $1 to $2 trillion, depending on exactly how you set those dials, potentially more if you took on some additional reforms. So it's a very serious sum of money. Now, Beyond that simple revenue point, one of the reasons that this proposal is so important, one of the compelling elements of it, is that it directly takes on a very important form of tax avoidance. And now, from an economic perspective, tax avoidance is basically burning money for the purpose of shifting resources from other people to yourself. If I set out to avoid some tax, I incur some costs, right? It may be professional services for accountants and lawyers. It may be a slightly suboptimal investment that I choose because it allows me to pay less tax, right? As a result of that, I pay less tax, but that just means higher taxes for someone else or fewer government services, right? So from the social perspective, I'm burning my own money to advantage myself for no gain, right? If a proposal that takes on tax avoidance, that shuts down these methods for tax avoidance, reverses all of these mechanisms, and basically creates money from nothing, which is obviously a great deal if you can do it. And so that's part of what's so exciting about a proposal like this one and like others that take on tax avoidance, is that you not only have a compelling equity case from addressing tax avoidance strategies that the wealthy can use to avoid tax, you have a very strong efficiency case that you're expanding the pie that our economic pie and lifting living standards through that mechanism. So finally, just a quick note on some of the ways that this proposal builds on principles or ideas that are already in the tax system. And by this, I don't mean that there are provisions for mark-to-market accounting in the tax code already, though there are. Right? What I mean is that the idea of the importance of aligning the tax treatment of a transaction with the economic substance of the transaction, that idea is already reflected in our tax code in a number of ways. And that the importance of that is not just about income measurement, but it's about that by aligning the tax treatment with the economic substance, you reduce avoidance. Right. And I think the most compelling example of this, to my mind at least, you may have other preferred examples, is original issue discount for debt securities. And now what this is imagine that I lend you $50 and 10 years from now, you pay me $100, right? There's no annual interest on this effective debt security that we've done. But the tax code would require you to report interest each year as if there were annual interest payments, right? It requires you to align the taxation of this debt security with the economic substance of that transaction. Now imagine for a moment that if we didn't have that, if I could just move my income into whatever year I wanted by structuring a debt transaction where I lend you money and then in some future date you give me back money, right? That would give me a lot of opportunity to move my income around in different ways to get the tax, to pay taxes in the way and the manner I like. Right. So we have these original issue discount rules that shut down those types of strategies. You can think of the anti-deferral accounting proposal, mark-to-market, deferral charges, all of these as ways of aligning the economic substance of capital gains income, so aligning the tax treatment of capital gains income with the economic substance of that investment income. And so in a sort of similar way, reflecting these ideas and principles that are already there, we require accounting that reflects the economic substance and shut down tax avoidance. And with that, I'll turn it back over to Seth.
All right, thanks so much, Greg. So I was hoping that we could, Senator Wyden's proposal, I think it's hard to overstate like how bold and pioneering that this proposal is, but it's also not entirely out of the blue. So I was hoping, that our panel could sort of put in perspective the development of this idea and where it is and how Senator Wyden is moving it forward.
So first to build off of what Greg was just describing. So this is a major step forward in the tax code. At the same time, as Greg was saying, the problem of people trying to put off, for instance, getting cashed in order to say that, I really did have an income, but just don't pay it to me, is an old game in the tax system. And in fact, we have a whole system that shares a certain word with the senator's proposal called accrual accounting, which was developed for big businesses to make sure you couldn't actually play those games. Now, this takes a step forward in that this then applies those same kinds of principles to transactions in property. But as Greg was saying, we've already done that with some kinds of property. During periods of really high interest rates, people were playing all kinds of games with debt. So they came up with the original issue discount rules. It's not just that it's building on ideas that are already in the code that help try to shut down these games. It's also building, I think, on a set of intellectual work that, frankly, has been developing over decades. This is a long-standing and known weakness in the tax code. So just to give a shout out to some of the folks who I think have really pushed this forward, for instance, there was a proposal by David Miller on mark-to-market taxation, who I believe is in a room and a leading New York tax lawyer, of addressing this several years ago. Eric Toder and Alan Viard of AEI and the Tax Policy Center had a proposal in the context of the corporate income tax. Ari Glogauer has worked on a proposal that tried to apply the retrospective tax. And so I could go on naming, because this has been a long-standing set of discussions in the tax world about how we try to solve this. And I think the key thing is it's a known problem, and now we have a leading policymaker in Senator Wyden, who is now proposing that we do something about it.
So obviously there's a lot of focus on how to raise revenue, especially with the levels of inequality that Indy discussed so well. How to raise revenue from the wealthy. How should we think about this proposal comparatively against other approaches to raising revenue and taxing the wealthy?
I think it's complementary to a number of them. So, for example, there are proposals to significantly increase ordinary income tax rates. And if we did that in isolation, you could create even greater incentives for people to shift their labor or other ordinary income into pass-through businesses and characterize it as capital gains. And so I think there's an important way in which, if we're going to raise ordinary rates, we should be thinking about seriously restructuring the taxation of capital income and capital gains as well.
Just to put this in a little bit of the context of the wealth tax, which is another sort of noted proposal in this area, right? I think you can think of wealth taxes and tax on investment income as an economic matter as basically two different ways of trying to get at the same thing. They're both looking to the relative undertaxation of capital income. One approaches it from the wealth side. One approaches it from the side of the income from wealth. Right. But why does wealth have value? It has value first and foremost because of the income it's expected to generate. So these two approaches are basically different ways of getting at the same thing, right? They differ on some of the finer points. They differ in sort of how they treat uncertainty and risk a little bit. And they also sort of tend to be proposed in slightly different ways in terms of whether it's an incremental reform to the existing income tax system or whether it's a additional tax on top, though you could design both types of proposals in either way. So I think there's an important sense in which the major reforms to investment income taxation and the proposals for wealth taxation should be understood as sort of attempts to get at the same kind of idea in terms of taxing wealth.
I'll just add, I think the central shift in thinking here is an appreciation for the fact that in economic and political terms, inequality itself has contributed to our lack of sufficient revenue. So I mean that in two ways. One is we obviously know politically that it has arguably allowed people to, it's not just that people are sort of playing games and cheating. The rules are rigged in such a way they don't have to cheat, right? So that's one way it's the case. But the other is, take the Social Security example. One of the reasons why Social Security is not projected to be able to pay out as much as it would otherwise in a couple decades is the fact that we've had so much inequality in wages and earnings, right? So a lot of the proposals there that we've seen lately, which I agree with Greg and Lily, are sort of complementary in many ways, similarly motivated. I think they're sort of grabbing onto the central insight here that to raise adequate revenues, we sort of have to take on the wealth, which allows for some political power, and the excess income of some of the people at the very top.
But add one other thing. There's if the comparison is to a wealth tax, I agree with Greg that there's sort of parts of a spectrum, and there's a lot of interesting ways to create a hybrid of the two. For example, the Netherlands has what they call a dual income tax, and they basically impute a rate of return that is taxed each year on a large swath of assets, which are mostly publicly traded. And so they're not exactly doing mark to market. It's in a sense more like a wealth tax, but they're calling it an income tax. You could also imagine doing that, which is a wealth tax, and then saying that's a withholding mechanism for an accrual tax more along the lines of what Senator Wyden's proposing.
Got it. So I wanted to ask a sort of a series of questions, kind of anticipating some of the either concerns or objections that we're likely to hear that I think that are worth thinking through. So I think the first, I mean, we sort of heard earlier, I think every time the conversation comes up about raising taxes on the wealthy, we always hear, well, the wealthy are just going to figure out how to avoid it. Or they'll just either move overseas or just like hide their assets overseas. So, I mean, for a broader audience, it's not like, immersed in things like FATCA and in these concepts. I was hoping to that you could sort of explain why they can't just do that.
I'll pick up on a comment that was just made, which is that in some ways you don't have to cheat because it's legal. And for a lot of wealthy taxpayers, the well-advised population, with the euphemism, it's about maximizing the advantages you can get from the rules as they are written. And so an important part of what proposals like this do is that they change the rules to limit the effectiveness of some of those strategies, right? But that while there definitely is illegal tax evasion, right, part of what's being taken on here is the legal tax avoidance, and that's sort of an important part of the strategy. On the second point, the moving overseas part of this, and I think this ties back to what David was saying in response to a question earlier. The increased globalization and the case that implicitly makes for increased taxation at the shareholder and investor level is also a case for why it matters less, why you, one supplier of capital, one investor, matter less for the broader economy. And so that's part of the reason why when you sort of think about what it means for people to try to avoid taxes, I mean, people, wealthy folks will try to avoid taxes. That is the way of the world, right? The goal is to set up a system that minimizes the extent to which that happens and minimizes the cost they impose on others in doing so. Right, and so this adaptation to globalization through increased investor-level taxation isn't part of response to those types of dynamics, and directly adapts the tax code to it in a way that delivers gains.
Just to build off of what Greg said, I think it's important to recognize that while surely some tax planning will always occur in any system, tax avoidance and evasion at the levels we have today is not an inevitability. It is a function of the laws we have. There's plenty of evidence that different kinds of tax regimes produce different kinds of levels of avoidance. Going back to the tax lawyer I was talking to, he was telling me stories of the shelters he was building in the 70s and 80s, which were totally absurd. They no longer exist today because, frankly, they were shut down in '86. So things don't always have to be the way they are. And I think when it comes to this kind of proposal, it actually is designed to get at some of that the sheltering we have in the current system that allows for deferral. And importantly, when it comes to international assets, the U.S. is in a unique position where we have, through a new law that was put in place several years back, now created an international reporting regime, which countries were basically forced to buy into. So there's a lot less ability to hide that money offshore. Exiting will impose an exit tax. So when it comes to U.S. individuals, this becomes a regime that, well, I'm sure they'll be planning, will be much harder to avoid, much harder to avoid than the current system.
Just to build on these points, I agree that any tax on the very wealthy, you're going to worry about avoidance. I think the main question is which kinds of taxes on the very wealthy will have the least avoidance. And I think there is reason to think that this kind of regime would do relatively well on that score. So there's three main things you might worry about in terms of tax avoidance. One is valuation gains, that the wealthy are very adept at saying that the assets they own are not worth as much as they are on a market. And Senator Wyden's proposal deals with this issue well because either if it is a publicly traded asset, we actually know the value and that's taxed annually, any gain or loss. But if it is not a publicly traded asset, then he waits until there's a market transaction. And so then you actually do know what the value is. And then he would impose a deferral charge to reflect the time value of money of not having to pay the tax. A second strategy would be to take advantage of C corporations and multinationals and own them and have them shift their profits to tax havens. And this has been a long-standing issue through something called transfer pricing. This doesn't actually work under this regime because if you own a multinational that shifts a lot of profits to tax havens, their foreign profits in those tax havens are still going to go into their stock price. And so you're still going to be taxed on the gain on all those foreign profits through the stock price as that increases on a mark-to-market basis. And then the last thing is you can just fail to report assets that you own and put them in offshore accounts. And as David and Greg have mentioned, we've made a lot of strides on that through something called the FATCA regime. Now there's over 100 countries that have signed on to exchange information about foreign accounts. There are some assets that FATCA doesn't cover, but there is another regime with over 100 signatories called the Common Reporting Standards that, interestingly, even though we haven't signed on to it, we get information through it on things like trusts. The IRS does need more resources to take advantage of all of this information they now have, and we have dramatically cut resources to the IRS, and especially for enforcement of taxes at the high end. But they now really have a lot more information than they did 10 years ago to police that just, purely lying about whether you own some assets.
So I think another issue is, I think the Affordable Care Act, which is still under attack in the courts, right? And the Trump administration is in court currently, right now, in the Fifth Circuit, still trying to overturn all of it, right? And based on a very flimsy legal theory that we would have laughed at if it weren't so tragic at this point, potentially tragic. So obviously progressives have to think about that there will be a full court press attacking any legislation after the fact in the courts. So how would we assess whether a mark-to-market tax regime like this is vulnerable to a legal or constitutional challenge?
I think it's really not an issue. I was talking to a prominent New York tax lawyer who also teaches a class on constitutional tax cases. He thought it was absolutely not an issue. The way that it is sometimes raised is there is a very old case, I think from 1920, Eisner v. Macomber, that said in an obscure context that you needed to have realization to have income. And the reason that mattered was because we obviously, the constitutionality of the income tax is clear under the 16th Amendment, but there's another provision in the Constitution that is very vague about, that says direct taxes have to be apportioned among the states. And it's very unclear what a direct tax is. At the Constitutional Convention, somebody asked, well, what exactly do we mean by a direct tax? And the notes say, nobody answered. So so you have to jump through a lot of hoops to take this old Eisner v. Macomber case, say it's not income, and furthermore, it is a direct tax. And then the other issue is that Eisner v. Macomber has basically been gutted by the court since then. A very wide array of commentators have said that realization is now just an administrative convenience. And while Eisner v. Macomber hasn't been explicitly overruled, it has been basically limited to its facts. There are circuit courts who have considered the original issue discount rules that Greg mentioned, which basically mark-to-market debt instruments. They have said that that's constitutional. So I don't think this is a worry, even given that, of course, the way the court is currently constituted, it could be more sympathetic.
You want to add to that, David?
So I guess first I agree with all of Lily's analysis, and I just want to emphasize the point she got to at the end, that to the degree anyone has objections along these lines, and let's be honest, there will be people out there who will say that this old case should govern, and that means that you can't do these kinds of reforms, that will ignore the precedent that exists in the tax code itself in the decades interceding, where we have since been taxing in important cases income that was not realized. I don't want to make predictions about what this particular court is going to do. With that said, it seems quite clear that an amendment which says that Congress has the power to tax income should mean that Congress has the power to tax income. And any traditional definition, if you go to like any economist, this is income, and it would be an absurdity for any court to then say that Congress, in acting under its power under the 16th Amendment, doesn't in fact have the power to tax income.
Got it. So another thing that I'm sure we're certain to hear. Well, first of all, let me answer one question. I'm not sure this has been quite clear yet. So, like, you know, for the vast majority of Americans, to the extent that they have savings, they save through, you know, for retirement savings, they save through vehicles like 401ks, right? So let me just ask a simple question: how would this type of proposal affect average Americans who are saving for retirement?
Sure. And so the proposal that Senator Wyden has set forth, right, has a $3 million exemption for retirement accounts, a $2 million exemption for homes, on top of a $10 million exemption for general purposes, right? So the short answer is it would not. You know, obviously, yeah.
That was the answer I was going for.
Yeah. So.
No, I mean, if you want to explain more, sorry.
Oh no. Right. Right. I think one of the important points on deferral is that retirement accounts basically allow you to obtain deferral, and then as a result, Congress has imposed very strict limits on how much can go into these accounts in various ways, right? But for taxpayers who can exploit realization-based strategies at the top of the income distribution, they've basically given themselves, you know, not unlimited, but vastly expanded, you know, retirement account advantages, if you will. And so part of what this is doing is saying, no, those limits are serious, and we're going to dial those back.
Okay, and so could this proposal, however, and I'm sure some will say this, you know, hurt average Americans, hurt the economy overall by depressing savings and investment?
So I think, you know, first order, right, the economic cost of this proposal would be borne, you know, overwhelmingly by the wealthy asset holders, right? And that's for some of the reasons we've been talking about globalization, for some of the reasons, for all of the various sources of capital that exist in the domestic economy. Any shifting of burden here would require movements in interest rates that I just don't think we should expect to see. So the first order fact is that the cost of this proposal would be borne by the relatively wealthy. But as with any tax proposal, that's an incomplete analysis because we're ignoring the benefits made possible by the revenues, right? And so, you know, the Senator Wyden has suggested using it for Social Security. I'm sure we'll hear proposals to use it in all variety of different ways, right? And when you account for those benefits, right, it's not just that middle-class families are not bearing the cost of the tax proposal. They'd be directly benefiting from the different services and investments that could be provided as a result.
I'll just add a little bit. I think on the topic of looking holistically also at the spending, some of the returns on investment possible from public spending are pretty much unrivaled in the private sector, and we're not making them. And that includes things like early childhood education and learning, but even some infrastructure and other investments. So when you think about all the things that drive our economic prosperity, using this revenue, well-targeted revenue, for purposes that can increase what people call human capital, but also even things like environmental protections, which improves children's achievement in school, investing in our food assistance system, ensuring that people have just basic cash incomes, have enormous payoff. You know, you take something like the food stamp program, which has enormous or the Head Start program as well, has enormous second-generation effects that reduces poverty in the short run, and in the long run could, and we know this from actual experience and the research, would increase people's school achievement, including post-secondary school, improves their health and well-being, reduces chronic disease, which would be a huge help for our healthcare system. A lot of programs like post-secondary education reduce criminal justice system involvement, one of the most expensive and most wasteful things that we spend money on. So it's hard. It's hard if you look holistically at a proposal like this not to see enormous potential in actually driving growth, innovation, when you also know that people at the top often use this wealth not necessarily to innovate, but to protect what they have, right? A lot of innovation happens by younger folks who don't have that kind of wealth. And we can use this revenue in ways that actually do more to promote economic growth.
Just add to that I think it's important to remember these points that India is making about what the revenue would be used for. But there's actually surprisingly little evidence that people's savings and investment behaviors responds much to the tax rate. Part of that is because of offsetting income and substitution effects. It depends how people make savings and investment decisions. But even if it did somewhat reduce savings and investments, you also you have to think what that savings and investment is going into. And so one thing is the revenue could go to very socially beneficial programs. The other thing is that deferral creates what's called a lock-in effect. It creates an incentive to hold on to assets that are underperforming purely for tax reasons because you don't want to pay that tax on the accrued gain. And so it has systematic effects of distorting savings and investment away from its highest and most productive use and reduces economic performance as a result. And this is a reason why people on the left and right, a lot of commentators agree that we should repeal stepped-up basis for this reason. This accrual tax proposal is sort of another step along that path. It's would repeal stepped-up basis effectively, but it's also repealing deferral advantages that create that lock-in effect.
So I guess ask one more question because we definitely want to leave time for audience questions. Well, one specific question. So I think one thing that gets raised, right? The stock market goes up and down, asset prices go up and down. So presumably the revenue from a mark-to-market, a tax system that's based on accrual, would go up and down, from year to year. Is that a concern?
So to my eye, no. At least certainly when it comes to the federal government. The federal government's revenues go up and down all the time. They vary with the economy. That actually is a good thing. So when the revenues tend to go down when the economy grows slower and recessions tends to actually strengthen the economy. Here, when people take losses when the stock market goes down, and to the people who are interested, like you would be able to presumably offset your losses against prior gains, for instance. That does not strike me as a problem. In fact, again, that probably on net tends to be a good thing. So, I do think that there would be a set of questions around how states would adapt to the system and whether they would choose to use the mark-to-market system or not. For state budgets, it's a very different thing given their balanced budget rules. And so some of the volatility could be problematic. But a tax analyst actually made the point to Lily and me the other day that from, for instance, even the state perspective, there could be some significant benefits, even with the volatility, simply because unlike the United States, states are much more subject to really high-income individuals building up their wealth and then moving out of the state. Say you're in California and you are in Silicon Valley and you move to Nevada. When you choose to sell your stock, they can lose a lot of their tax base as a result. This would avoid that problem for states like that.
Interesting. That's very interesting. And so finally, Senator Wyden, this is this is a white paper, fairly detailed, but not yet legislation. What input would you get? And he's actively soliciting input on the proposal as he writes it. What input would you? What do you think the most important things or most important input you would give him on this proposal?
I'll build off what Lily said. Enough resources for IRS enforcement. I think that we need that anyway. We've needed that for a while. And directive, too. Some folks have probably seen the ProPublica analysis showing that the IRS spends more time going after EITC applicants in some of the poorest counties in the country, disproportionately African American, than they do going after some of the highest income tax units in the country. So I think I would be very strong on ensuring that the IRS has what it needs to make this work, and it has the directive to make sure that it can do the job.
I think one interesting design question is going to be how to design the exemption, and I would tend to lean more towards a wealth-based exemption than an inc.
This is the exemption that
For the-
limits the mark-to-market system to the super wealthy.
Yes.
Right.
Yeah. So Senator Wyden has said this would only apply to the top 0.3%, 3 in 1,000 people, and the white paper says that it would be an income and assets test, and I'm glad assets is in there because I would worry a little bit if it was just income, how much people can gain, the definition of income to avoid that threshold. I think the other interesting thing is how to phase in the regime above that threshold, and I was glad that he said there would be a phase in. If you just sort of abruptly said once you cross $10 million of assets, you're suddenly in this regime going forward, full stop, you could create really big incentives to try to avoid that $10 million asset threshold. So I was glad that there would be a phase into that.
So I plan to do some careful reading, honestly, because I think this is a really exciting proposal, but one where I also need to do some thinking in terms of where I'm reading. And I think as Senator Wyden and the Senate Finance staff have already done a lot of thinking, anytime something gets a different treatment, you have to see if the different treatment would really end up with a different tax result. Where it does, that's an opportunity for planning. And it's clear this, on the whole, reduces those opportunities a lot. But things that I want to think about are for those who aren't on the mark-to-market system, what the deferral charge would be. And I think they actually asked for feedback there as the appropriate one. I also want to think about different kinds of business entities, the relative treatment of partnerships and S corporations, for instance, which I would hope we could try to equalize to the degree possible. So it's those areas that I particularly want to frankly do some careful reading as to what they've proposed and see how it works.
So I'll agree with David on the work to be done to provide comments, which I look forward to doing. I'll offer two ideas today. First, information reporting. And so anytime we're thinking about sort of a new or different approach to running the tax system, the administration side of this is incredibly important. And thinking about how we can maximize the value of the information reporting, both in terms of what the IRS needs and in terms of what the taxpayer needs to comply. I think one area that shows up is trying to make sure that the information returns are focused as much as possible on the gains and losses on the actual income itself. That's sort of one area to maximize that value. The second thing is I'd encourage them to see this as an opportunity to address other weaknesses in the code that are also complementary with making this proposal effective. And the particular area I'll highlight for that is trusts. We have sort of several well-known avoidance strategies in the trust space, which I will not bore you with details of. I'm thinking of things like GRATs and CLATs, but those trusts could also potentially be an avoidance, a means of avoidance for a proposal like this. And so I think this is an opportunity to both address those existing problems while also proactively preventing them from creating problems for a new proposal like this.
Fascinating. So questions from the audience. So I think Diane's going to come around with the microphone. So just please say your name, affiliation if you have one, and question, not a speech.
Okay. Carl Pulzer, Inequality Inc., INK.org. I already told you more before. So if the conservatives and Republicans in the Senate really got cornered and had to consider getting rid of deferral and loopholes, I think what they're going to come back with, and it's important to me as a small-time capitalist, right now when you pay taxes on capital gains, they don't take into account the erosion of the asset through inflation. You pay, like if I put $10,000 into Good Works Incorporated, and in 10 years ago it's worth $20,000, but only because of inflation, then I'm losing a lot of money in taxes. And that would be rationalizing the system to the real economy. But nobody talks about that. That's what the Republicans are asking for. If that was included in a deal, question, how much would that reduce the payoff to the taxpayer, the revenue that you get? And does it make sense to include something like that in a deal? Does it make sense?
Yep. Who wants to address that?
So look, I think that the question of inflation indexing can only make sense as part of a comprehensive reform. And importantly, if when we're doing inflation indexing for these kinds of gains, you'd want to do inflation indexing for all kinds of assets, including on debt. So right now people take deductions and business owners take deductions on interest, but they take deduction with including the basically, they get a deduction for inflation. And so if this was part of a comprehensive plan, which properly taxed all of the gains and then made an adjustment for inflation, then I think that's something that would be worth consideration. I just want to distinguish it from both the proposals that have been made so far on the Hill on inflation indexing capital gains, and then the off-again, on-again discussions in the administration to unilaterally index capital gains for inflation. Those are one-off proposals that would index only part of the system, a part of the system that already gets a preferential rate, with one of the justifications for that preferential rate being the fact that inflation is included. You would open up opportunities for all kinds of tax planning if you had inflation indexing on capital gains, but not, for instance, on debt. And finally, even though it sounds like the administration is not doing it, I think their quote was, at this time, they do not, in fact, have the legal authority to unilaterally do it. But again, I think it should only be part of the conversation as part of a comprehensive reform of the system.
David's written a extensive paper on the legal issues with unilaterally indexing inflation that I definitely would recommend with his co-author, Dan Hemmel.
Hi, I'm Joe Sparks. I host and produce the Medicare for All Explained podcast in collaboration with Physicians for a National Health Program. And I see an elephant in the room when it comes to taxes, and that's healthcare costs. And I've talked to two economists, and one of the things they talk about is the private taxes of health insurance premiums, because you have to pay them. And before a person was mentioning, the effects of like Head Start and the good effects. So my question is, you talked about using it for Social Security, but if we don't do something about healthcare costs, it's going to make the government go broke or substantially have to reduce Medicare. So how would you address that? And right now, families are really struggling with healthcare costs. And boy, if you get sick, there's it's unaffordable now for many people. People are giving up vacations, they're cutting back. So in terms of this, how would you address that?
I'm not sure we have the time to explain how to fix the healthcare system, but it's a good question. I think you raise a particularly important point, which is, in a sense, people have to pay something like a tax for basically meeting this fundamental need, and thus a shift to public provision, even with taxation to fund that, doesn't necessarily really show up in making people's disposable income worse off, can actually make them much better off. And so I think, we're talking about sort of direct sort of federal taxes, but in a meaningful sense. I think you just underscored a valuable point, potential use for this revenue, other revenue. Just to be clear, the healthcare system as it is right now, Lily talked about the importance of transitions. I mean, the healthcare system as it is right now is so out of whack in spending that you need a very serious transition to something else, and you need to raise far more substantial revenues than even this proposal could. So I think that you're right more broadly long term that we have to find a way to contain costs, but without reducing access. Just to underscore that, the sabotage of the Affordable Care Act, whatever you think about it, seems to have led to some increases in uninsured rate, despite us being in basically the longest economic expansion history, almost the longest as of last year. which is pretty astonishing and appalling. But anyway, hopefully that helps.
Other questions here, and also my what are you saying? Some of my colleagues have written about the issue. I mean, there's the bigger issues, but the issue of market concentration among healthcare providers, in the sense that some of the providers have sort of monopoly power in the market, and how that increases costs for consumers and for the government as well. So we're this work that we're actively thinking about. So question back there, and then I'll get you. So.
Yeah, Ari Glogauer, Ohio State Law School. I just wanted to follow up on the previous, or 2 questions ago, this interesting idea of this reform being seen as part of a grand bargain, so to speak, with different elements that could appeal to perhaps different constituencies or views. And one aspect of this is the indexing for inflation. And I'm wondering how you think about a potential other aspect of this, which is the recent corporate rate reduction, which arguably increased the benefits from the realization rule and the stakes for deferral and the opportunities for deferral. And maybe that toothpaste could go back in the tube or not, but is there a sense in which the corporate rate cut is leading us to a degree down this path of more fundamental reforms?
I think that's an interesting question. As David and I were working on our paper, the strategy for disguising labor income into lower tax categories traditionally has been for many years to put it in a pass-through entity. And the large corporate rate cut that was part of the 2017 bill has made putting that labor income in a C corporation a potentially viable and useful tax planning strategy for the wealthy as well. So I think there are ways that this kind of proposal could serve as an important backstop to the corporate income tax, especially at such low rates. I also want to shout out to Eric Toder and Alan Viard's paper. There is an interesting question of whether to give credits for corporate taxes paid if one is being taxed on a mark-to-market basis at ordinary rates. And I think that could make a lot of sense if you were applying an accrual tax to everybody. That is not what Senator Wyden is proposing. He's proposing applying it to a tiny share of the population. But there are some interesting interactions that way as well.
And then I think our last question here. Thanks.
So I'm not getting how this is protecting the middle class. So in non-retirement mutual funds, one of your parents 20 years ago put $1,000 in some fund with a mix of equities. Each year they've been taxed on dividends, ordinary capital gains. Now it has $5,000 in it. When they pass away, they want to give it to their grandchild, who's much in need of it, to pay for student loans. And there's a stepped-up basis of $5,000 instead of $1,000. A simple example, I could use real property. I'm not getting how this proposal protects that person's middle class doing that. So could you explain that?
Good question. Fair question.
Great question. So as I read Senator Wyden's proposal, there's just a total exemption for the first either $10 million in wealth or $1 million in income. So in your example, if a parent gives $5,000 or $50,000 or $500,000 to their child as a bequest, it wouldn't apply to that because the child and the parent are both way below that $10 million threshold. And furthermore, the $10 million threshold doesn't apply to retirement assets. I think you were talking about outside retirement assets. Yeah. Yeah, but they'd still have $10 million of non-retirement assets before they'd have to worry about this.
And then there's one issue with the rates, right? Because he's changing he's equalizing all of the rates between ordinary income and capital gains, but has said that that his proposal, when fully fleshed out, will fully protect middle-class families, and is asking for further input into that. So, excellent. Are there any? Does anybody have sort of final thoughts? we'll leave it at that. I think this has been a great event. Thank you so much for attending, and we've been proud to host it. So I just want to thank all our panelists and all of you. Thank you.